Hello everyone, welcome back to my channel. So this video marks the beginning of the week number 52 in this road to 100k realized return challenge. Uh, First of all, I must apologize because unfortunately I could not make the video as earlier as I wanted, and so basically I can only do it at this time. It's earlier. It's early in the day on Tuesday, so we already went through one trading day on Monday. But just to give you some sort of perspective of what happened yesterday. Yesterday, the markets went up in the pre-market, but and continue to stay relatively up in the case of the S&P 500 and the Nasdaq. But however, it was not the case in the case of IWM. When it comes to the our ATF on small caps, and basically they try to emulate the performance or replicate the performance of the Russell 2000, as you can see here. Even though it went up in the beginning of the session, and we managed also to stay even beyond $224 for some time. It was pretty much downhill from this point onwards, and it continued to go in the downhill trajectory. And even though, of course, as you recall from the last video, we had bought 1,100 shares at a price of $223, and because the markets were up, and at the beginning of the trading session they were around 223.70. There was no point at the time to sell the calls with a strike price of 223, and so we sold calls with a strike price of 224 in order to try to sell them $1 higher, and we would pocket at that point. If the calls were assigned, we would be able to pocket $1,100. As you can see here, these are the calls. The calls were sold at a very good premium, I should say, 48 cents. So we managed to pocket a little bit more than $500. However, because the stock came down, we were not able to sell the shares, and we still went a little bit above. We also went ahead, and because these calls were almost at zero, were at 1 cent, we bought those back, as you can see here. And so we managed to close the position and still get a profit of $506, including the already net of commissions on the to open the position and to close the position. And then we also sold another set of 11 calls, but with a strike price of 223, of course with a much lower premium, as you can see here, only 4 cents. We also of the 11 contracts, we still managed to get 2 of those at 5 cents, but the rest had to be at 4 cents. So on average, this is a little bit more than 4 cents a piece, which, as you can see, because the stock closed at around 221 and some change, this expired worthless. So we managed to keep this profit, this entire premium for ourselves. So around 44 and a half dollars, which was a pretty good performance of our shares in terms of the premium we collected. Of course, it would be better if we were able to sell those at 224, but yeah, markets did not went our way in that regard. So, but it's okay. We still managed to, as you can see here, we managed to get our average price so that to close to 222. So if we sell, I believe that now with the calls that we are going to sell today and the premium we will get, we will be able to get our break-even point at 222 if it's necessary. at this point in time, there's no necessity to sell calls at 222. We will, because the price is very much around 221, we will go ahead and sell the 223. I try to break even at least on the price, and we keep all the premiums for ourselves. Because I believe that the calls for 224 will yield a very low premium, and of course the likelihood of getting there is much lower. And so because of that, yeah, as you can see here, these are prices from the closing prices from yesterday, but the difference is significant. It's 2.5 times as much if you sell the calls on the with the 223 strike price. Keep in mind that these prices will be different when the market opens again, but nonetheless, we will attempt, if nothing changes, if the price when by the time the market opens, if it stays around this time, we will go ahead and sell the 223 calls. So we will try to break even on the price and keep all the premiums for ourselves. Because we also had some extra cash, we went ahead and sold 2 puts on the ARKK. Now, this was a situation which I think it showcases how volatile this ATF is. And if I show you here the 1-day graph, basically what happened is something like this. This is a 1-day chart, and I recall that we sold these 2 puts at around this time. So the stock was around 79 and some change, and we managed to collect a premium, if I'm not mistaken, at 37. Yeah, 37, and we still went for a probability of profit, market implied probability of profit of around 86%. I was trying to go for the 90, but it's interesting, and this also showcases how volatile this ATF is, and even relative to the historical volatility. The volatility reflected on the premiums are very high, and as you can see here, the premiums are very much close together. We went for this one, which now of course is a lower probability of profit because the stock went down, but if you see here, this is 73. If we go one strike down, is only increases by 76. This one should be around 79 or 80. So you see, as you go further and further down on the option chain, the probability of profit increases very little. If you compare this, for example, with the IWM, which is a much less volatile ATF. For example, here you get the 81%, much closer to the price, to the stock price. And for example, if you go one strike down, it has a 9 percentage point increase in the probability of profit. So even here 5% increase. So this showcases how volatile this ATF is. It gives us more premiums, but this also meant, as you can see, because the stock came down by just around 2 points, $2, the probability of profit came down by 13%, and the premium almost tripled. So yeah, I don't know if these puts will be assigned or not. We are not going to buy back these puts. If we are assigned, so be it, and then we will try to sell the calls on the ARKK again. But yeah, it's good because it give us a lot of premium and give us an outlet to put to work our excess cash. But nonetheless, yeah, it frightens a little bit because yeah, the premiums are juicy, but it comes at a price, and the price is a very high volatility, which of course volatility is not our friend since we are using short positions on options. But hopefully, because the stock is whipsawing back and forth, we will be able eventually to sell the shares if we are assigned at some point by selling calls on it. So at this point, I don't see a problem with that. When it comes to Pfizer, again, the cruelty of the market remains. Now it's even under the price of the so-called resistance price or support price, depending on which side you are of the chart. But apparently now it's down it broke the support of 2450, and now it's back again under 2450, and so now this is a resistance, and apparently, yeah, we sold the shares, but still we were not able to get back the money we wanted on them, and now I don't think that it makes any sense to buy more shares of Pfizer. We will try to wait and see if these recover a little bit so that we can offload these 40 shares that remain in our portfolio. Yeah, and for the time being, this is it. I think that if we account for all the earnings that we have since we started this journey, and because the premiums that we have been accruing, I believe we are very close to the $30,000 mark again. But I will have to see, and then I'll post it in the thumbnail for you guys to see. For the time being, this is all, and feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you have any questions. And also, of course, feel free to like the video and subscribe to the channel, and we'll reconvene at the end of the week to close out this 52nd week and see how the trades went. And I'll see you there.